Good morning, ladies and gents, and welcome to the March 2026 edition of the Blackfinch 10-minute market forecast. Thank you for joining us today. My name's Jordan Kent, Distribution and Sales Exec for Blackfinch Asset Management, and my co-host today is Assistant Portfolio Manager, Mr. Josh Clayton. The purpose of this webinar is to address some of the most important events that are making headlines across the globe, providing you with our interpretation of how they could affect markets and how this feeds into how we manage our portfolios. If you have any questions during today's session, then please do submit them using the Q&A box. Alternatively, you'll be provided with our contact details at the end of the webinar, where you're welcome to submit them to us directly. Now, before we begin, it's important for me to note that the detail covered this morning is intended for financial professionals only and shouldn't be interpreted or taken as financial advice. Now, with the news of the Iranian and US conflict over the weekend, it shouldn't come as a great surprise that that's going to be the primary focus this morning. Well, we'll be looking at globally what the economic fallout could be from the conflict and what it could mean for global markets. And within the US specifically, how the latest tariffs have created clear winners and losers in trade policy and why diversification is more important now than ever. With that, I'll be handing over now to Josh Clayton to provide us with all the detail. Good morning, Josh.
Thank you, Jordan, and good morning, everyone. Now, this is a very timely webinar given the weekend's events, and I really want to hone in on this conflict, and we'll touch on tariffs as well. We really do think this can shape the coming weeks and potentially months, depending on the duration of this conflict. But before we dig into the charts, I just want to stress that these are always fast-moving developments, with the conflict being the most obvious and impactful to markets over the shorter term. But importantly for your investors with a long-term investment horizon, episodes like these often tend to be like ripples in markets rather than big waves that materially reshape them. But as always, let us know if we can give any reassurance in times of this volatility. So let's start with the conflict. So over the weekend, I'm sure you know, the US and Israel have carried out airstrikes against targets inside Iran. Iran has responded with attacks across the Gulf region, raising the risk that this becomes a wider conflict than a short contained event. And Iranian state media have confirmed that Iran's supreme leader has been killed in the strikes, and his death represents one of the most significant political shocks that Iran has experienced in decades, and this really does materially increase the uncertainty around how things develop from here. But unsurprisingly, the first place markets expressed this risk was in energy. Brent crude oil moved sharply higher as trading opened, with oil futures moving closer to $80 per barrel, reflecting an immediate geopolitical risk premium. And futures markets adjust very quickly to new risks. They reflect expectations, not just the physical price today. And this is the market pricing this uncertainty around disruption to supply routes, particularly the Strait of Hormuz, which is this critical artery that accounts for roughly 20% of global oil flows. But the broader market reaction has been relatively measured. Safe haven assets such as gold, especially the US dollar, have seen support, and equities have kind of softened modestly. But importantly, we've not seen the kind of disorderly repricing associated with systemic shocks. And the second chart kind of helps us explain why a little bit more. So before I walk the chart through, just some very quick thoughts from us here in the investment team. Bear in mind this war is unfolding and conditions are evolving. But first, the immediate impact of the war on the global economy appears to be limited at this stage, as the world economy has greatly reduced its dependence on fossil fuels. Also, some of the other events or conflicts, especially listed on the chart here, have also shifted the supply of global energy. It reinforces this point that I'm going to go through on improved diversification. Second, this is a different war from last year. It involves an attempt at a regime change. And this is an existential event for the Tehran regime, whereas the 2025 war wasn't. So although the supreme leader is being killed, what comes next is anyone's guess. And finally, the third point, the Strait of Hormuz, especially, it's this critical oil transport section, and it has begun to choke off some oil flows. And sadly, this is inflationary, especially depending on the duration of the conflict. But global financial markets could feel the negative impact of rising energy costs in certain pockets. And I want to re-stress the conflict's duration will be the key factor here. So let's bring in the chart. Let's explain what we've been seeing in financial markets. So what we've plotted here is the Brent WTI spread. So Brent crude originates from the North Sea. It serves as the benchmark for European, for African and Middle Eastern markets. And you then have the West Texas Intermediate benchmark, and that's for US oil sourced from American oil fields. And OPEC uses Brent crude as the pricing benchmark, which influences global oil prices. And when this line moves higher, it shows Brent crude becoming more expensive relative to US oil. And that usually happens when investors believe geopolitical risks could disrupt global supply. So they bid up the Brent faster than the WTI. So, in other words, markets aren't responding to the shortage today. They're pricing in the risk of disruption tomorrow. And we saw a similar pattern to a larger extent with Russia's invasion of Ukraine, where the spread widened as investors were anticipating these sanctions and supply uncertainty. So this is a good gauge of geopolitical tension. We can see that it's already begun widening before this escalation. We saw similar behavior ahead of previous conflicts, including Russia-Ukraine. So in other words, markets were positioning for elevated geopolitical risk. And when risk is partially priced ahead of time, it reduces the likelihood of sharp dislocations, and investors have begun already hedging certain energy exposure, moderating risk. And that's why if you've been checking the market indices, of course they're in the red. This is a slight drawdown, but they have been much more muted than what a lot of people have thought. So whilst the situation's clearly serious, it's unfolding, markets are functioning rationally, they're adjusting and not panicking. And I think the bottom line is that both the duration and the aftermath of the war are still unpredictable. But we have to bear in mind Trump does have some tough midterm elections. I'm sure he doesn't want a war that drags on, where oil prices skyrocket and it hurts consumers at the pump. So this would make you want to believe there are good reasons that Trump will aim for this quick resolution if he can achieve it. But for the moment, brings us to the key question: what should investors do? Our answer very deliberately is not much. Events like these are exactly why portfolios are built to be diversified across asset classes, across regions, economic drivers. Attempting to trade around geopolitical headlines, it's very rarely rewarded. Maintaining balance and allowing different exposures to respond in different ways is normally best placed. Should the duration of the war carry on, issues become more deep rooted. At that point, we'll then look to assess if the investment case has materially shifted for the worse. But for the moment, whilst all of this is developing, we are comfortable with our position, our diversified position at Blackfinch, and we really would encourage you to relay that to your clients that we are monitoring this very closely. Now, while the conflict's dominating news flow, there is another development going on, and that's the change in the effective tariff rates following US policy adjustments. So alongside this geopolitical backdrop, there's a quieter shift taking place in global trade, and based on current estimates, this new revised tariff structure that Trump has implemented has been affecting countries very unevenly. If we look at the chart, the blue bars show the February baseline effective tariff rate, and the red bars reflect the position following the IEEPA removal and this additional 10% adjustment. And what's clear is this creates dispersion. There are very much clear winners and clear losers at the regional level. And let's take Brazil as the example. Under the previous reciprocal tariff structure, some of its key export categories were facing very heavy pressure. With this revised framework, effective tariff rates are materially lower for them. For a country that's a big exporter of commodities, things like coffee or agriculture goods, this improves their ability to compete under the new regime. So rather than this uniform tightening across global trade, we're seeing differentiation. And that's important from a portfolio perspective because we are diversified across lots of different regions. We hold much more of a significant allocation to the likes of emerging markets, to Asia Pacific and Japan, much more than a lot of our peers. And we've deliberately done this to not be reliant on a single tariff outcome or return driver. So if trade policy shifts in one direction, exposure elsewhere can help offset that. And it's important to stress this policy landscape is still developing. Tariff rates could change again. So it would be imprudent to anchor portfolios to one assumption that could shift. But as things stand today, the direction of travel isn't working against our positioning. If anything, it modestly reinforces the benefit of maintaining exposure beyond some of the most tariff sensitive economies. And that really brings us back to the broader lesson I've taken away from this conflict. Whether we're discussing military conflict, trade policy, concentration can increase vulnerability. I'm stealing a famous investor's term, but diversification is the only free lunch in investing. This is no more important than what we're seeing today. So, stepping back, there are three key takeaways, three key themes. First, the move in oil reflects this immediate uncertainty, but at this stage, it's a risk premium. We're going to need more data to understand if this is a longer lasting structural shift or supply shock. Second, changes in tariff policy are creating dispersion across regions, and that's exactly where diversification adds value. And third, environments like this, discipline matters. We focus on long-term positioning and not reacting to short-term events. And that's everything from me. So Jordan, I'll pass back to you for the wrap up. Thank you, everyone.
Thank you, Josh, and thank you everyone for spending your morning with us. Also, we hope you found today's session useful, and as promised, if you do have any questions you've not had the chance to submit on today's content, or if you'd like to hear a little more about our suite of managed and tailored portfolio services, please reach out to us using the contact details on screen. Otherwise, that does conclude this morning's webinar, and we do hope you'll join us next time in the instalment on the 7th of April, which will be airing at the same time of 8:50. But for now, I'd like to wish you a very pleasant day on behalf of all of us here at Blackfinch Group, and we look forward to speaking with you again very soon. Bye for now.